Welcome to This Explainer. Today, we're diving into the ultimate masterclass on Bollinger Bands, pulling directly from some of the best expert trading sources out there. Developed back in the 1980s by John Bollinger, this whole indicator is built on one core principle: mean reversion. It's the idea that price eventually always wants to return to its average. Okay, let's unpack these strategies and see exactly how they form a highly structured, rule-based edge. Okay, let's quickly look at our roadmap. We'll start with mastering Bollinger Band basics, then move right into dual confirmation and indicators, trading W and M patterns, breaking down a specific mean reversion scalping strategy, setting strict rules for execution, and finally managing risk and stop losses. Section 1. Mastering Bollinger Band basics and understanding price deviations. To successfully trade in sideways markets, we really have to deeply understand how price deviates from its historical average in the first place. So when you're looking at your trading setup, a Bollinger Band essentially consists of three distinct lines. The middle line is just a simple moving average, or SMA, usually set to a 20-period default. But those upper and lower bands, that's where the magic happens. They represent standard deviations away from that middle moving average. Honestly, think of these bands like a giant, highly elastic rubber band stretching around the price. Statistically speaking, the price is going to stay within those outer bands about 95% of the time. And because price stays inside those bands 95% of the time, whenever it actually touches the upper band, that indicates a highly bought or overbought market. Conversely, if it touches the lower band, that signals an oversold market. This is exactly what sets up the potential for mean reversion, that inevitable snapback to the middle line. But listen, here is the critical warning. Simply touching a band is not an automatic signal to buy or sell. Relying on a simple touch is a total trap, and it literally wipes out beginners every single day. Section 2, Dual Confirmation and Indicators, Filtering Out False Signals. So if a simple touch of the band isn't enough, how do we actually find those high probability setups? The crucial point here is indicator stacking. You should absolutely never rely on one indicator alone. If the Bollinger Band shows price hitting that lower oversold band, you need to wait for a secondary confirmation. For example, look for a MACD crossover, where the fast line crosses above the signal line, just to confirm that bullish momentum is actually stepping in. Or you could verify with a supertrend indicator shifting from red to green. But most importantly, you must wait for a candlestick to actually close to confirm the reversal. Trust me, getting that dual confirmation drastically increases your probability of catching a winning trade. Another really powerful way to read the bands is by looking at their overall width, because Bollinger Bands are excellent for predicting volatility. When the bands contract and become very narrow, it's called a squeeze. And in the market, low volatility always leads to high volatility. A squeeze is basically the market taking a deep breath before a massive, explosive move. Now, while the squeeze doesn't tell you the direction, it completely warns you that a breakout is imminent. Conversely, wide bands indicate high volatility and an expanded market range, which, as it turns out, is exactly when our mean reversion setups work best. Moving on to Section 3, Trading W and M Patterns, Spotting Reversals. These are classic price action patterns that form in direct relation to the outer bands. And this brilliantly illustrates how raw price action pairs with your indicators. A W pattern or double bottom happens when price hits or breaks the lower band, bounces up to the middle, and then drops right back down to form a second low that ideally stays inside the band. This forms a clear W shape and signals a powerful bullish reversal. The M pattern or double top is just the exact opposite. The price hits the upper band, pulls back, and then pushes back up for a second peak that shows total exhaustion, forming an M. Buying or selling the neckline breaks of these patterns provides incredibly high probability entry points. Now, you might be wondering, general theory is great, right? W patterns, M patterns, overbought signals, they're all great. But how do we actually turn these concepts into a strict, algorithmic, rule-based trading system? Because let's face it, if you are discretionary and just guessing all the time, your account balance is going to suffer big time. Section 4, the mean reversion scalping strategy, step-by-step for Sensex. Now, we are going to apply these concepts into a rigid, heavily backtested 1-minute strategy. The source material outlines some very specific indicator settings for this exact setup. We are looking at a 1-minute time frame on the Sensex, so you're either trading the spot or 100 points in the money options. Now, the Bollinger Bands are tweaked a bit from the default. You're going to change the length to 30, but keep the standard deviation at 2.
Doing this filters out a lot of that erratic 1-minute noise. Next up, the RSI limits are tightened. Set your overbought level to an extreme 80 and oversold all the way down to 25.
Okay, let's see how this builds into a perfect long entry. Step 1. You absolutely must wait for the price to cross and close entirely below that lower Bollinger Band. Step 2, the very next candle must be a green, bullish candle that engulfs at least 60% of the previous red candle's body. And step 3, check your RSI. It must have crossed below that extreme 25 level. When all three of these align, boom, you have a high conviction buy signal pointing right back to the middle band. To short the market, we just mirrored the exact same logic. Step 1, the price must aggressively push up and close completely above the upper Bollinger Band. Step 2, the immediate next candle must be a red, bearish candle that covers or engulfs at least 60% of the previous green candle. And step 3, your RSI must be absolutely screaming overbought by crossing above 80. This tells us the market has stretched that rubber band as far as it can possibly go, and the mean reversion snapback is about to happen.
Section 5, strict rules for execution. Because discipline is key. Even the absolute best strategy in the world will fail if you lack ironclad execution rules.
Rule number 1 is all about timeframes. You must execute these trades only between 10:15 in the morning and 2 o'clock in the afternoon. Why? Because that first hour of the market is full of volatile gaps, massive expansions, and just erratic institutional positioning. Trading a mean reversion strategy during the morning gap will absolutely result in false signals and traps. Wait for the market to settle into a rhythm after 10:15. And after 2 p.m., volume can totally dry up or get wildly unpredictable, so we pack up and protect our capital.
Rule number 2 is the number 3. 3 is the absolute maximum number of trades you are allowed to take per day using this system. If you take 3 trades and 2 hit your stop loss, you are done for the day. Close the laptop. This hard limit completely eliminates the urge to revenge trade. Mean reversion works best when the market is cycling naturally. If the market is trending heavily in one direction all day long, this strategy will fail, and taking 10 trades trying to pick the top or bottom will wipe out your account. 3 strikes and you walk away. Now, what's really interesting here is this 60% rule. When looking for that reversal candle outside the band, it cannot be weak. It must visually cover at least 60% of the previous candle's body. So if a red candle drops down out of the band, the responding green candle needs to push up well past the halfway mark of that red body. This visual rule is fantastic because it filters out weak, invalid reversals and ensures actual institutional momentum is backing your trade. Finally, Section 6, managing risk and stop losses, protecting your capital. Because if you don't know exactly where your emergency exit is before you enter the market, you shouldn't be trading at all. For this strategy, we are throwing away those arbitrary stop losses like, oh, I'll just risk 20 points or I'll risk $500. No way. Instead, we use the ATR, or average true range. The ATR is a volatility indicator that measures exactly how far the market is moving on average per candle. Using the ATR for your stop loss is far superior to guessing random numbers because it dynamically adapts to the market's current volatility. If the market is moving fast, your stop loss widens to give the trade room to breathe. If the market is slow, the stop loss tightens right up. So here are the final risk management parameters to lock in. Set your stop loss at exactly 2 times the current ATR value. For your targets, aim for a minimum of a 1-to-2 risk-to-reward ratio. This means you are risking $1 to make 2. Mathematically, a 1-to-2 ratio means just 1 winning trade covers 2 losers. If a trade works in your favor, look to secure those profits as the price touches that middle 20-period moving average. Above all else, never chase loss recovery. Respect the math, follow the rules, and protect your stack. Bollinger Bands are incredibly versatile, but they demand respect. The strategy is super clear. Wait for the overextended price, confirm the momentum with the 60% rule and extreme RSI, cap your trades at 3 a day, and let the ATR manage your risk. So the question is, will you master the discipline of mean reversion, or will you let market volatility dictate your trades? Apply these strict rules to your next session, stay disciplined, and watch how it transforms your edge. Thank you for joining this explainer, and I'll catch you in the next one.